Hi, and welcome to Midas Investing. Today we're going to be taking a look at Home Depot, ticker HD, which is one of the largest specialty retailers in the United States and definitely the largest retailer in the building supply subspace. I'm very excited to be taking a look at this company because I do think it's come down pretty significantly from much higher levels of valuation. And we'll be taking a look at where I think it currently stands today and where it might fit into a portfolio that's interested in the home improvement theme. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Taking a brief look at their presentation from their fourth quarter release, you can see that their sales growth was up about 30 basis points in the fourth quarter from the previous year, down in comparable sales about 30 basis points. So in general, most of the growth we can see is a result of management of store operations as well as price adjustments. And you can see as well that the diluted EPS is up about 2.8% from the previous quarter in that last year, this being the fourth quarter. Also, in the quarter, they made a pretty significant investment in their hourly frontline associates, about $1 billion in annualized compensation to be expected on a forward basis. This is something that seems to have happened throughout the building supply space, what with their major competitor Lowe's also making an announcement of large increases in annualized compensation. One other interesting thing that they point out here is the increase of about 4% in sales from their digital platforms in the fourth quarter of this year compared to last year. And they also talk about 45% of their online orders being fulfilled through the stores, which is, I think, is really one of the reasons I like this company and think it has a strong competitive strength, which is to say that even in this digitized world where people are ordering lots of things online, Home Depot sells a lot of the type of products that simply can't be shipped to homes very easily or just be ordered online with at easy will. A lot of type of products that you have to really get your hands on, you have to look at, or you have to bring from place to place at a much larger cost to the person ordering, which means a lot of orders being fulfilled through the store. I know in their actual 10K, they reported that over on a year, it was actually closer to 50% of the orders being online ordered through the store. They also talk about how the pro sales are outpacing the DIY sales. I like to think of the DIY portion of their business as really where the large portion of the moat comes from. As I was saying, in general, you think home improvement, you think Home Depot, or at least in the United States, that's the perspective. It's a very much a ubiquitous brand name. But the pro sales are definitely going to be where a large amounts of the volume come from for this company. And then thinking about the geographic disbursement throughout North America, as I was saying, it is ubiquitous in the United States, but they are also existing here in Canada and Mexico with 182 stores in Canada, 133 Mexico. Taking a look at the fiscal 2022 total year sales about $157 billion, which is over $6 billion in growth for the year, 3.1% in total comparable sales for the year. So we saw that on the fourth quarter, they didn't quite get so much of the comparable sales, but a little bit so on the year, with diluted EPS of 16.69, which is up 7.5% from the previous year. And then switching to the news release for their earnings release that they had, they also gave guidance for 2023 of sales growth and comparable sales growth to be approximately flat compared to 2022, and then operating margin of about 14.5%, which is going to reflect those increases in the hourly frontline associate costs. And then also they're expecting diluted earnings per share to be about a single to mid digits kind of percent decline on the year. So switching gears a little bit to this spreadsheet, which is my company list by industry, you can see that this particular selection I have here is the retail building supply space as it is listed by the data set that I get from Aswath Motoron, which is the group that Home Depot and Lowe's is a part of. This is where I'm also going to be getting the beta for my company is from this particular select industry grouping. However, one interesting thing to point out about this group is that if you actually take the total sales for this industry grouping in the United States, Lowe's and Home Depot combined make up like 85 to 90% of the sales for this particular grouping. So when I'm trying to think about like an actual industry in terms of like sales for the total space, I'm not just going to be relying on the retail section of building supply, but also the building materials grouping as a whole. Just one thing I wanted to point out, it's going to be relevant when I get to my model here shortly. But in the meantime, I really wanted to point that out because I wanted to focus specifically on their obvious major competitor, that being Lowe's. So this right here, I brought open the table of merchandise by different product type in Home Depot, which is here on the right, and then Lowe's, which is here on the left. they're going to list things in slightly different categories and then also in different orders, which is a little bit frustrating. Lowe's listed by percentage listing, which is frankly the more useful way to have listed it, while Home Depot for some reason decided to list all these in alphabetical order. So it makes it a little bit frustrating to try to look at these exactly. And then, like I said, the categories themselves are not exactly the same, but it can kind of give us a little bit of an idea of some of the differences between Home Depot and Lowe's by product category. Right off the bat, the one at the top is actually one of the more obvious and biggest differences between them, which is the Home Depot has about 9% of their total sales coming from appliance sales, while it's closer to 14% for Lowe's. So it's a pretty significant difference there, with 14% being the largest section of Lowe's sales product category. And this 9.2% is actually not even the number one for Home Depot. It's actually the second largest compared to the 9.5% for indoor garden. But then that's kind of a little bit of a misleading thing, because if you think about it, says indoor garden, and if you focus then on the product categories that Lowe's has here, they have their lawn and garden as one particular category. So for example, if you take 9.5% in indoor garden of Home Depot and then combine that with the outdoor garden, which is 6.4%, then that gets you already to a 15.9%. So that right there, you can see it's closer to double the amount of lawn and garden that Lowe's has, that Home Depot has, and that makes that their number one category by this particular category types, if you were to try to coalesce them into somewhat similar categories. And that's just one example. I think there's one or two others that aren't exactly aligned with each other, but really just the appliances and the differences between garden and how those two are almost flip-flopped in their allocation size was one of the major things I kind of wanted to point out. Another major thing to point out, just the actual absolute value levels of these sales, because obviously Home Depot is much larger in scale than Lowe's, with 157 billion in sales in 2022 versus Lowe's having 97 billion. So right off the bat, if you just focus then in on the actual absolute value levels of it, you can see, for example, with appliances, they actually have relatively close to the same absolute value, 13.5 billion, 14.4 billion. So really, Lowe's is only $1 billion or shy relative to that, despite the huge percentage differences. So it just shows like how the actual absolute value versus the percentage of their own individual sales, that makes a difference. A little bit to it, but the point though of why I'm trying to like point that out specifically is that also a major difference would be in lumber sales, but it comes down to not necessarily the percentage difference, because for example, Lowe's has 9.8% of their sales coming from lumber, while Home Depot has only 8.6%, but the absolute value of it is significantly larger, up at closer to 13.4 billion versus 9.5 billion. So a little bit more larger of a sensitivity to lumber sales. What my opinions on how this actually does affect things, personally, I'm a little bit of a bigger fan of the spread that Home Depot has between this. Appliances, if you are particularly hoping for a specific bet on the type of cyclicality that appliances gives you, this might be a better bet for Lowe's in particular, because a lot of those appliances are actually going to end up being relatively high margin products. But as I kind of just said in the previous sentence, they are going to be much more cyclical and therefore potentially more discretionary. Depending on the types of appliances, there's a little bit of a mixture there. Whereas I think some of the other categories that Home Depot had larger strength in, as we're talking about things like in garden, while those two can also be a bit more discretionary, I think that the type of cyclicality they're built in is more suited for the overall home improvement type theme, which is something that I'm particularly interested in. Other categories that I think Home Depot outshines Lowe's in, both in absolute terms and in percentage terms, would be like in electrical lighting, with 8.7% for Home Depot versus the 5.5% for Lowe's, as well as plumbing, which has 5.5% for Lowe's, and for Home Depot has 8% over here. So you can see a little bit more stronger strength in some of the more maintenance related categories, which again fits into that theme that I'm interested in. Now, keeping with the comparison between Home Depot and Lowe's, we're really going to drive this one all the way through to the point, because I really do think that Lowe's is basically the only truly comparable company to Home Depot if you're thinking about it. So here we have the chart of their gross margins over the last 10 years. You can see that for the majority of the time, HD does have stronger gross margins. There's a little bit of a period in the past that Lowe's had higher gross margins. I'm not sure. I haven't looked as closely at Lowe's financials as I have at Home Depot, so I don't know if there was maybe some changes in their business that explains this kind of this little change from the higher level of margins up in the upper levels of 30s that came down into the lower levels of 30s here, and then it's kind of bounced back here. Either way, it shows to me the HD has in general shown a little bit more consistency, at least with its unit profitability. And then moving down the income line to EBIT margins, we can see that trend continues a little bit further, with HD's EBIT margins being consistently stronger than Lowe's, being anywhere from somewhere in the kind of like the 11% range to possibly up around 15% as it currently stands. So kind of in between there, kind of like mid-teens, pretty solid EBIT margins, whereas Lowe's has had a little bit more of a volatile kind of track record, so to speak. Maybe higher single digits was what we experienced during the first kind of 5 years of the historic time frame, and then ever since COVID, they've really had an explosion in the EBIT margins, which if I was making valuations for Lowe's, I would definitely have maybe a little bit more questions about where a terminal margin was going to end up for Lowe's, if this type of explosion in the margins is sustainable or not. Whereas with Home Depot, I have a little bit less questions about that, and making a projection about those margins in the future. Switching now to asset turnover, which is a measure of capital efficiency, which is sales over assets. So it gives you kind of a measure of how many times within 1 year could you buy your assets over again if you had to spend all of your sales on said assets. You can see consistently as well, we have HD generally being stronger than Lowe's, except for maybe these last couple years right here, which is a little bit interesting, and it kind of will fit into some of the other charts I'm going to show right here. And then this chart, which is total liabilities as a percentage of total assets, which I think is very important. One, because it gives us an idea of just how much risk is each of these companies taking on relative to each other, but also I think it helps to explain the asset turnover chart that I was talking about, where Home Depot was underperforming Lowe's for the last couple of years. I think this chart helps to explain. You can see over the kind of longer term time frame, Home Depot has had a higher percentage of total liabilities relative to Lowe's, so they were actually a little bit more levered than Lowe's, and that would actually be one of the first major knocks against them for this particular part of the time frame in this kind of historic perspective that we've looked at. But then here in 2020, they start to close the gap a little bit. In 2021, they actually do surpass them. So now Lowe's has a larger percentage of liabilities. They're more levered now than Home Depot is, and that trend has actually continued pretty significantly for the last 2 years, with Lowe's increasing their leverage pretty dramatically, whereas Home Depot has leveled off and even, you could even argue, tapered down slightly in percentage terms relative to the peak levels. And now, since we were just talking about total liabilities and the actual leverage levels that the companies are experiencing, let's take a look at the actual risk that perhaps is being experienced as a result of that. This is EBIT relative to interest expense for each of these companies, which is interest coverage ratio, a very good kind of measure of just how easy is it for a company to pay their interest. Basically, it says if they had to spend all of their EBIT on interest, how many times over could they pay their current interest charge, and you can see it kind of over the consistent time frame, with HD having a little bit more interest protection, generally speaking, over the kind of whole historic time frame. And then remember, this is kind of the time frame when Lowe's starts to be levering themselves up a little bit more consistently. And while they were levering themselves up, you can see that their interest coverage was actually rising. So with them levering up, I would say that means that they were probably lowering their interest rate. So perhaps that was a good move for Lowe's. You could maybe argue with that. But then interest coverage seems to have dropped pretty quickly in the following year. So I don't know, maybe some of those maturities happened. Maybe they had to change the interest rates or something like that, or maybe they were allowed to delay their interest rates or something like that. But Home Depot is having a little bit more of a consistent time frame with that. So either way, I would say that kind of makes the leverage scenario of Home Depot seem a little bit more appealing. And then focusing in on a specific subset of the current assets that I really want to focus on, I think is very important, especially when you're looking at a retailer, which is inventory turnover. So taking a look at the levels of inventory relative to cost of goods sold. So it's basically saying like, oh, relative to the amount of sales you're doing in a year, how many times can you move your inventory within a year? This has a more consistent picture than at least the total asset turnover. You can see HD, including even in the last few years, still has consistently higher inventory turnover than Lowe's. And now switching away from operating ratios for the companies, let's take a quick look at pricing over the historic time frame. Listed here, I have the next 12 months, the forward EBIT to enterprise value ratio, as well as the normalized PE ratio. Again, forward metrics for each of them. So you can kind of see pretty consistently with the black and the blue, which is for Home Depot, versus the green and orange. Each of the different ratios seem to be at kind of a slightly different level for a lot of the time frame, though they seem to kind of converge a little bit here in the kind of 2019, 2020 kind of time frame. But nonetheless, we can see that in general, Lowe's seems to be trading a little bit cheaper than Home Depot pretty consistently throughout this 10-year time frame, though it seems to also be converging a little bit in the last few years, especially in the most recent kind of period, as we can see right here. Lowe's, and being the green and the orange, is definitely lower than both of the lines for Home Depot. And now those were forward ratios, which is the type of ratio we want to use when putting in a terminal multiple. But either way, it's good to see how those expectations of earnings actually played out against the actual earnings experienced by the companies. So here we have the actual last 12 months trailing enterprise value to EBIT ratio and PE ratios for each of those companies. And so we can see a kind of similar trend as we were saying before, with the PE ratio being a little bit higher than the EV to EBIT, and then it kind of converging in the last few years. But then nonetheless, throughout the time frame, you can kind of see, for the most part, Lowe's trading a little bit cheaper than Home Depot in both of the ratios, but not necessarily by as wide of a margin for the actual experience ratios, which what I would argue is maybe that the perceptions that Lowe's was going to grow faster than Home Depot was maybe what was going on for this entire decade. All right, now switching over to take a look at the model that I built for Home Depot. This model is somewhat similar to kind of a general framework that I've been developing and using for retail companies in general, which is to say that what I kind of like to do is take whatever store level information I can gather from the companies from their annual reports, like stores, transactions, average tickets, as well as the actual store count and employee count, square footage, and other metrics like that, upon which I can kind of build ratios and like per unit metrics. And then I also like to take operating lines, not just obviously things like revenue, but also cost of goods sold, SG&A, as well as inventories, and then take ratios between some of those other metrics like employees versus inventories and things like that, cost of goods sold versus inventories, SG&A per employee, things like that, inventory per square footage, and make a bunch of ratios relative to all these different metrics, and then use basic statistics to try to figure out which of these metrics is driving the revenue. I don't really use one specific rule of thumb for each retailer. I try to let the data essentially drive my decision making for how I'm going to build the model. Now, to show you what I mean, right here, for example, I have the total transactions for Home Depot, as well as the average ticket size that they report. And here I have the correlation, as well as the R squared, which is the coefficient of determination. So we can see that there's a 60% correlation between the transactions that they have and the actual revenue growth that they experience as a company, and that it has about a 36% explanatory power within that model. Then taking a look at average ticket, which would be the other half of the equation for the revenue, you can see that that actually has a 72% correlation with a 52% explanatory power. So what that tells me is that the average ticket size actually has 50% more of an effect approximately than the actual amount of transactions that come through Home Depot. So the pricing power is really going to end up being more important as a result. Then it comes down to taking each of those metrics, transactions and average tickets, and try to figuring out, based off of some of those operating metrics I talked about, what can be used to figure out what's going to drive each of those things. And for example, we have listed here the total amount of stores that Home Depot has and how much they've grown over the 10-year time frame. And I took a correlation between the total amount of transactions and total stores to try to see is like, oh, is the amount of transactions that they have actually related to the total amount of stores they have? And turns out that they're actually negatively correlated to almost 16%, which isn't really a strong correlation to begin with, but definitely not positive. And the explanatory power is about 3%. So yeah, basically nothing useful to be seen based off of the amount of stores they have. However, if we then instead take transactions correlated against the total amount of employees, we can see that there's actually an 83% correlation between the number of employees that they hire and the amount of transactions that they grow in that particular year, with a 69% explanatory power. So you can see, like, just by using some basic statistics, you can determine whether or not stores or employees are more relevant to the actual growth of the company by just following the chain a little bit here. So that's transactions, but what about average ticket size? So we can take a look at some other metrics. Now, employees have a major effect on the total transactions. How much of an effect do they have on the ticket size? It turns out that they actually only have about a 17% correlation, the employee growth with the average ticket growth, with only a 3% explanatory power. So while they do seem to have a pretty large effect on the amount of transactions that the company can process, it doesn't seem to really drive the pricing that much. Now, I did play around with a variety of the other metrics as I talked about, like taking gross margins and inventories, employees and SG&A, inventories relative to square footage per store, inventory per store, a variety of these things, trying to figure out what the best metric would be to actually give me some sort of information about where average ticket size comes from. And funnily enough, the thing that I found the best explanatory power was inventories per store, which I thought was pretty interesting. So it's almost like the amount of goods you have in the store helps drive the ticket size, perhaps maybe because that offers more things that the customer can purchase on their way through. I'm not entirely sure what rationality you want to use for it, but either way, I found an 85% correlation between the growth of the inventory per store on a year-over-year basis to the growth of the average ticket size on a year-over-year basis, with a 71% explanatory power. So very, very strong. And the reason why I like to focus particularly on those types of metrics like cost of goods sold and SG&A and inventories and things like that is because then I can then use those same metrics to drive an idea of where the gross margins are going to be, as well as some of the operating costs, and therefore getting myself to an operating margin for the company. So I can use this model not just for building the revenues, but also getting myself to some sort of profitability level. Now, taking a brief break from discussions of like how the KPIs are affected by statistics, taking a look at kind of like the broad overview of the industry. As I was kind of talking about when looking at the industry select grouping that I have, I decided that I wanted to go beyond just the retailers for building supply, but also add in total building materials. So using Asphalt the Motoron's data set, I combined the total sales for each of those industry groupings for each of the years from 2014 up through 2022, which I have up here. And I went to see what the actual COGR was for that particular 8-year time frame, which ended up being about a 10% growth of sales per year for that particular 9-year time frame, which is pretty impressive. For Home Depot, they themselves grew about 8.3% for that time frame. Lowe's grew at about 7.1% during that time frame. So you can see Home Depot grew relatively strong in that particular grouping, while the overall industry grouping still grew rather strong, relatively stronger. And the reason why I added in building materials with the retail building supply, as I kind of explained before, is partially because that group was so small, and with Lowe's and Home Depot making up such a large percentage of the sales there, I figured that there was going to be a little bit of some error in the data set, especially given that the sample changes year over year. So I wanted a much larger sample set to take out some of the fuzziness within that statistics. But either way, I wanted to get an idea of what the market share was for each of Home Depot and Lowe's, which is partially why I did that. So Home Depot and Lowe's share each of that combined industry grouping. Home Depot's went from 43% down to about 37% in 2022, with Lowe's going from 29% down to 23% or so in 2022. So you can see a decline for each of them. And so I was kind of curious, it's like, okay, what's going on with that? And like I said, it's partially because the sample changes for each of these years, which is partially why I wanted a larger sample size. The leftover, which is basically what's not Home Depot or Lowe's, you can see right here, it goes from 25% upwards towards 40%. And you can see in some years, it has a relatively large jump up within a single year. And that's years in particular where I think the data in the sample set is probably having some fuzziness, and there's probably maybe a large amount of companies being added to that grouping in that year. So maybe it's a little bit of a weird fuzziness, which is why I really just kind of wanted to get an idea of the difference of Lowe's versus Home Depot. It's really kind of the purpose here, is just to see the relative strength of Lowe's versus Home Depot. So Home Depot minus Lowe's, the difference between the two I have right here: 14%, 14.5%, down to 13%, down to 12.9%, 13.8%, back up to 14.2%. So over this 9-year time frame, the average difference between the two in market share being about 13.6%. I would say marginally at any given point in this, it's basically been about the same. It seems like relatively they seem to be about the same. If I take a ratio of each of those percentages, it's basically the same story, 1.5% all the way basically through. So 1.6%, or well, not percent, 1.5 as a ratio to 1.6 for the last 2 years, but even so, it's like just a marginal difference. So basically, Home Depot and Lowe's over this 9-year time frame, it seems like, relatively speaking, in market share terms, they haven't really moved anywhere. They're basically just kind of consistently about the same. And in fact, the industry seems to have even grown a little bit around them, which could perhaps maybe give more opportunity for them in the future. Now coming back down to the inventory per stores and how we're going to build that up to the average ticket size. I took the average of the inventory per stores for the 10-year period, and then used the growth rate that I'm using to push out to the 10 years and adjusted that average for the 5 years midpoint that pushes it out to. So basically taking that average and multiplying it by the growth rate of 4%, which I'm using as the growth rate that it had grown from 2013 through 2019, which I'm going to say is basically closer to maybe like a steady state inventory growth. It had a much more accelerated inventory growth in the last few years. It's just really just a basic assumption I'm using here. But either way, that gets me to possibly 12 to 13 million of inventory per store in 2032. Now, as I said, average ticket size seems to be heavily correlated with the growth of the inventory per store. So using that 4% growth rate that I'm having inventory per store growth at, but then adjusting it for the level at which that the average ticket size had lagged behind the inventory per stores for the previous 7-year period prior to 2020, that gets me to a percent increase of possibly around 6% per year for the next 10 years in the average ticket size. That compares to the 5% that it has been for the last 9 to 10 years in the historic time frame. So I don't think it's too unreasonable, but that gets me to an average ticket size of $162 or so in 2032. Now, as we said, trying to figure out the amount of transactions that they're going to be able to process, we figured that the amount of employees seems to be a very strong indicator for that. Now, trying to figure out the amount of employees that they're going to have, we're thinking about the total population that those employees have to serve. So I'm comparing the total employee base for Home Depot with the total US population. Yes, of course, they do have Mexican and Canadian properties as well, but I'm just going to use the US population as my metric. So I have the population per employee right here as a line, which you can see is about anywhere from 800, 700, 600 or so per employee. And the thing you can see is it consistently has been dropping over this 10-year time frame. So the amount of US population per employee hired has been dropping, possibly because of those Mexican and Canadian properties, but also possibly because they've been increasing the size of their properties as well. I didn't have the square footage line up here because, like I said, I didn't find very good statistical information from the square footage line, but I assure you the square footage per store has been increasing over this time frame as well. But either way, so going from almost 900 of population per employee down to around 700 population employee implies that they're able to get many more employees into each store, which means more employees to service more customers. So we're going to argue that that trend might be able to continue even further. I have it going at about a decrease of 2.3%, which is the rate at which it decreased for the 10-year time frame. So that gets us to possibly 563 of population per employee, which if I work backwards from that, that gets me to employee base of possibly 638,000 employees in 2032. That compares to the 472,000 or so they had in 2022, which grew up from 365,000 in 2013. So I don't think it's entirely unreasonable. That does get us to a compounded growth rate for the 10-year time frame of 3% per year, which is basically the same as they had for the 10 years prior to that. So again, I don't think it's entirely unreasonable. Oh, and I forgot to mention that's based off of estimates of what the population is going to be according to the US government. So with that employee base and the commensurate amount of transactions that we're expecting based off of the overall increase in square footage that I was just talking about, that gets us to potentially 1.5 K transactions per year in 2032, which is worth noting is actually down from the amount of transactions that we have in the more recent last few years. So if anything, I would argue maybe that's a more conservative measure, again, with maybe a little bit more bold increase in the average ticket size. So a large increase in the average ticket size is what we're seeing versus potentially moderating in the total transaction size. You could argue maybe that's a less DIY business and more pro business, hard to argue, or maybe there's some moderation between my assumptions here. But either way, that gets us to revenue in 2032 of $245 billion or so. Now, as I said, with the whole inventory per store kind of metrics, as well as the transactions and the amount of transactions per store metrics and the employee metrics we use, I can work backwards and use a lot of this information to also get an EBITDA margin, which I can work to also get myself an EBIT margin based off of the capital expenditures that I'm expecting for the company. So the estimate that I end up with for 2032 potential EBIT margin for the company also ends up being about 15% based off of this model. So with that, we can bring it all together and take a look at the valuation output and the distributions that I come up with for Home Depot as a company. As you can see, our expected revenue I have right here is a 257 billion with our model output revenue as our base case here in the median case model. And then the bull case and bear case assumptions, I just adjusted it by about 25% upward and then divided by 1.25 to kind of get us a general kind of range for the revenues. I really just had one general output for that revenue model. And then I did tilt pretty significantly towards the more bull case relative to the base case to get me to this expected revenue right here. But either way, that gets us expected growth for the next 5 years of just under 5%, just over 5% for the 5 years after that, for about a 5% CAGR over the 10-year time frame. You can see the cumulative growth cases as they are right here, incremental growth outcomes right here. For the margins, as we talked about, I have a model output showing that they could potentially sustain a 15% margin, but I did kind of pedal that back a little bit more conservatively to my terminal margins being closer to about 14% on the expected case right here. But I am allowing them to get up to over 15% margins for a lot of the kind of years here in the middle kind of time frame, while experiencing also a little bit of lower levels of profitability in the next few years or so. But getting us to operating incomes on a median case of anywhere from 34 billion in the median to possibly anywhere from 31, 32 billion to 43 billion for about 50% of the outcomes. You can see on the graph right here, the operating margins over the 10-year time frame, the operating income distribution in the terminal year. And then for my capital assumptions, we really have them doing net reinvestment of just a little bit over 1% of sales per year, which is more than they did over the 10-year time frame from the last historic period, but less than the last 5 years in the historic time frame. So kind of somewhere in the in between there, which is going to get us expected returns on invested capital very, very strong in around 36 to 37% on a 10-year basis expected, with our expected free cash flow pretty strong as well right here. You can see the distribution of those outcomes, free cash flow distribution kind of at a midpoint, maybe around 25 billion, with lots of potentiality for some pretty large amounts of free cash flow with this kind of very lopsided skew. And then putting that valuation together, we really do end up with very, very strong excess returns, both over the next 10 years and then also on a terminal basis. I am applying a relatively strong terminal multiple for Home Depot, given its very, very strong brand name, a very, very high upper teens level with decent skew up to higher into the 20s for a terminal multiple basis. My expected value, as you can see right here, with about 50% of the outcomes I find between about $230 per share and $300 per share, with the median case around $265 per share. You can see the fair value distribution listed right here. So yeah, lots of the outcomes right here, and not too far from fair value based off of this metric right here. And then the expected returns distribution requisite with that is right here. And here you can see a basic summary of the expected case valuation with the percentile that's currently trading at in the value distribution being about 70%, but not too far from fair value. So we'll have to see whether or not it comes back down to lower levels here in the near future. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for our valuation of Home Depot, ticker HD. As you can see, it's getting pretty close to fair value, and what with its very, very strong brand strength and strong association within its industry, definitely would be a great company to add to the portfolio. We're really, really hoping to get it at higher expected returns in the near future.